Okay, so welcome again. In this case, we have the honor of interviewing Justin Carbonneau. Justin has been involved in all aspects of building two investment-related businesses, of which he's a partner, an asset management firm, and an online equity research company for nearly 2 decades. The first company, Validea Capital Management, is a SEC registered investment advisory firm, which runs a series of systematic models through separate accounts, an ETF, a robo-advisor offering, and through pass-up advisory mandates. The second business is Validea.com, a fintech company where they run a series of quantitative strategies through various online premium products and tools. He is co-host of the Excess Returns podcast, along with Jack Forehand. Hi, Justin. How's it going? Everything okay there?
Yeah, everything's great. Thank you guys for having me.
It's our pleasure. So, Justin, my first question is, what drove you towards the investment industry in the first place, and what's your story?
So I'm going to reminisce here. It's funny you asked this, because last night I was talking with a good friend and I was reminiscing and thinking back to my high school and college track and field days. So the beginning part of my investing career actually starts sort of around that time, which is I was in college. My best friend and I got internships at a brokerage firm in New York City. So we got on a bus, went to New York City without a place to live, interned. Well, we actually lived for 1 week at a YMCA. For half the summer, we lived on the floor of one of the brokers' apartments in Queens. And then the other half of the summer, we were lucky enough to have a fraternity brother who his family had a place in the city. So we lived there. But this was my first sort of entree into the world of investing. And this firm have you guys ever seen the movie Boiler Room with Ben Affleck?
Yep. No, well.
That was basically this firm. It was like these interns. I was responsible for making like 600 phone calls a day. As soon as I got someone on the phone, I handed it off to a broker, and these guys would just sell. They were great salesmen, but it was like the old school sort of brokerage days, and it was exactly what they pictured in Boiler Room. But so that was a great experience. I mean, I did learn about the market to some extent. We had to read Barron's over the weekend and stuff like that, but it kind of taught me, it really showed me what I didn't want to do. Sometimes in life and in your career, you kind of have these good experiences, but it sort of opens your eyes to, maybe things that you didn't want to do. So I didn't really see myself doing that, even though it was a good experience. And then fast forward, we got back from New York, and we were still in college, and my friend and I answered an ad for research analyst interns, and that was a position that John Reese, the founder of Validea, was advertising for. So this is kind of bringing us to the late 90s, early 2000s. I was on the founding team, if you will, of version 1.0 of Validea. And I won't go into all that, but essentially, we raised about $5 million in venture capital financing. We went from a handful of part-time people to 50 full-time people with offices in New York and Bloomfield, Connecticut. And I actually managed the largest sort of group of analysts at that time, which we were scouring financial periodicals and looking for recommendations, and we would pull those recommendations out and we would track the performance of those recommendations. So that was a very manual, intensive process. But what that also, very early on in my career, it gave me this ability to sort of curate. I mean, that's one of the things that I think I'm good at, is like looking at investment related content and curating it. In parallel, what was being developed at Validea was these GURUS strategies or quantitative models that still exist today to a large extent. And so I'm trying to get to sort of where we are, because that's a long time. This is like late 90s, early 2000s. The company basically, the dot-com boom and bust came. We not only built the company, we had to dismantle the company. So in a 2.5 year period, it was like drinking through a fire hose. It was building this company, thinking we're going to be all multimillionaires, to we're going out of business and I'm laying off team members each and every month. But what was really important here is that John Reese, the founder of the firm, and I think this is a very important lesson for entrepreneurs and creators, is that because he had patents on some of the underlying technology with those guru models, when the company dissolved, John Reese basically took ownership of those patents and technology. And at that point, sort of that Validea sort of went away. We still had this deal with NASDAQ, but anyway, so Jack and John, so you guys have talked to Jack, he's my other partner now. They basically came together and said, let's make this a subscription-based product. Let's enhance the product to some extent. And where they pulled me in, I was actually going back to graduate school after Validea sort of 1.0 went under, but they tapped me to help with business development. I had a lot of contacts in the media. So I got Validea at that point, a lot of press that was very important for building the business. That helped the subscription business become very successful at that time, especially given the cost structure. And then in 2005, we launched the asset management firm. So since, I would say, I've been in the online subscription-based space with Validea since 2003, but really on the asset management side, when we launched in 2005, John and Jack basically pulled me in to help build the asset management business. And so, I mean, since then, it's just been building strategies, having a premium investment research product that both professionals and individual investors used. We sub-advise mutual funds in Canada for a long period of time. I've worked with a lot of clients over the years in terms of directly investing with Validea, and also our subscribers that need sort of guidance with using the Validea website. So that's kind of like my story. I just I started it sort of way back because those early days are like formative experiences for all of us, and it was fun. It's just funny how just last night I was reminiscing about high school and college, and now here I am again. So totally. I appreciate you asking that.
So so it seems like it seems like kind of systematic investing in those guru models were an important part of kind of, as you framed it, Validea 1.0, and also kind of the relaunch. And so I don't know, maybe just develop that a little bit, and kind of talk a little bit about kind of the guru models and
Sure.
what you guys do, and how that form of investing kind of became core to what you're doing.
Yeah. So kind of, and this is the big breakthrough for us, and it might not seem novel now, but it was at the time. So we were running. So imagine we have these, at the time when we first launched Validea, we had 8 guru strategies. And I say guru, it's Benjamin Graham, John Neff, David Dremin, Buffett came in December of 2003. So these are, famous, great investors that had to some extent outline their investment strategy in either books or academic papers. So what we were doing at the time is we were extracting those strategies and then building models where you could type in a ticker symbol, and we still have this, and you can see how those particular strategies score a stock. So it would look at all the different investment criteria and say, would the Buffett model, would Validea's Buffett model, how would it rank this stock? Mm-hmm. But the important breakthrough where it really launched our company to the next level is when Jack developed actionable model portfolios to sit on top of those strategies. Because it was great to say, how did the stock score? You can screen, but when you can actually start building, and the way we do it, we do 10 and 20 stock models on Validea, but that aligned performance with these guru models. And at the time in 2003 and 2004, this was quite unique. And it was, the idea of like emulating Benjamin Graham, which by the way, I always like to call it, this was like magic hour for like US value stocks. It's like, from 2003 to 2007,
right?
We were just in the right place in the right time with these strategies and tracking the performance. So it was a very interesting story to say the least. And investors,
and which by the way, the current market has some of those flavors. If you look at what's happening with the maybe the yield curve and kind of some of the movements and rates and the starting points in terms of valuation dispersion and that sort of thing. This commodity, the behavior of commodities. There are definitely some some rhymes between the current market today and perhaps that that kind of 2003 2007 period. Which is interesting, and that's and you touched on something that's interesting too. You're kind of building models. What investors do is they take models, but they have to apply them, kind of out of sample, right? I mean, you take history and you say, well, either great investors, or just various factors that behaved certain ways in certain points in time, but the trick is, today isn't a certain point in time. Today is today. And so it's kind of being able to take, those learnings, those methodologies, but apply them into, what is kind of always and at every point in time an uncertain future. And so that's, so it sounds like you guys kind of made that pivot basically.
Yeah, and over time we've added, we started with the initial set of models that we launched on Validea, which was in 03. And then since then, we've continued to look for strategies that maybe are a little bit more unique, sort of diversify the model lineup. And so a lot of those have kind of come out of the academic world, I guess. Yeah.
Yep.
Actually, there's a thing that, I mean, if I were to start investing right now, I would read as many books as I could to get a sense of what's going on in the investing thing. And actually, I think this is what happens with many novel investors when they start investing and they start reading books. There are two kind of books where you can find practical strategies that you can try to clone. But additionally, there are another type of books where you need to make kind of an interpretation, because it's not that easy. They don't explain exactly the secret sauce. You have been building strategies on both type of books, and my idea, or the question would be, can you elaborate on the mission and this idea on how a novel investor that wants to start investing by using Validea could start, and how he could get the most out of it?
I always like to start out with that question around try to understand as best you can the strategies that we follow. So you're right in the sense that a lot of these books about investing, they're very loose in terms of their definition of, buy low PE stocks. Well, what does low PE mean? Low PE below 10, half the market? Are you talking about the trailing PE, the full, whatever? That's just one silly example. But but what we have tried to do with the strategies that we run, and there is, with it, to some extent, some interpretation that had to be made, but it's very important that we can get very close to the investment criteria that's being utilized or espoused by the individual. So what I would say is on Validea, you can go into each of these investment models or strategies and you can get high level and low level. High level is, what type of strategy is this? Is it a value strategy? Is it more of a quality type of strategy? Is it a growth type strategy? Is it a growth at a reasonable price? And then I always, and maybe it's wishful thinking, but hope that investors try to align themselves with the model that makes the most sense to them, because that's going to be the one that probably they're going to be able to stick with the most over time. It's not necessarily the one that has the best performance. Like if you go to the website right now, you might see, XYZ at the top, but if you don't understand it, and then all of a sudden the strategy starts to outperform, well, guess what? You're probably going to jump ship as soon as, you have the first 10% decline. So for me, it's about, if you can use the Validea site to get a very good, solid understanding of the inputs into these strategies, trying to think about why they might work, even what their weaknesses are, which, by the way, they all have weaknesses. And then, just trying to get aligned best with what model is, and that's sort of the way you do it. And then, by the way, each of these strategies has either a book or academic paper behind it. So if you want to learn about, Deshaun Heng's twin momentum investor model, well, guess what? That paper is available on SSRN. Maybe that's a little bit too heady in the academic world, but if you want to read about, Joel Greenblatt's magic formula strategy, which is much simpler, well, there's a book on that too. So, you can really peel back the onion on all the strategies we run, because they're all based on publicly available sources.
Interesting. Yeah.
Yeah, I think you touch on something interesting there. Just kind of tying back to investor behavior, and conviction, and I think so much of success in investing is kind of being comfortable in your own skin, and so because no strategy works all the time, and in fact kind of being able to kind of stick with strategies when they're out of favor is actually kind of what plants the seed for success down the road. So kind of understanding what you're doing, what you're investing in, and kind of investing in line with with kind of your behavioral kind of predilections, I think is so key to long-term, long-term success.
Have you guys read Jim O'Shaughnessy's What Works on Wall Street?
Yeah, sure. Well, that's
So,
super thick and complicated.
well, I mean, but it's
I love it. I love it.
I have the book. I have the book here. I was going to read a quote from it, but I'll save you the pain. But obviously, this is a very intimidating book. If you look at this thing, but it's just full of data. But I would say any investor that's interested in anything I'm saying here and about models, this is probably the seminal book on simple quantitative strategies. And
agree.
Where he starts though is why models are better than humans. And you have to, I think, believe. Now, again, models aren't perfect. And there are some human stock pickers and investors that are much better than models. But models do a lot of things that can keep us out of trouble as investors. And I would just say if systematic investing, mechanical investing, these types of strategies are interesting. O'Shaughnessy's book is probably for not maybe the beginning investor, but anybody that's past the beginning stage. And the chapters are pretty, because what he does is he will test each factor, if you will, and then he kind of has a not composite factors, but ultimately he blends different criteria together to come up with different strategies that are optimal over time. But a lot of it, especially the beginning, is about why models are good and humans are full of emotion and biases and all the stuff that gets us in trouble. So I would highly recommend that book for sure.
It's super interesting because actually I use this book in a second step. I always say, okay, if you want to start learning about this quantitative investing, so first read the Joel Greenblatt book, because that's super easy, super it's kind of no-brainer. But then this one, What Works on Wall Street, because this one is where you will find really the secret sauce about all of this, all of these strategies. So I agree totally. So there's another question that I have regarding, there's a book called Shareholder Yield Investor by Meb Faber, a good friend of us, by the way, where Meb lays out a strategy that looks for stocks that pay dividends, pay back their stocks, and pay down debt. The addition of those three variables is called shareholder yield and measures a firm commitment to shareholders-friendly practices. In addition to shareholder yield, this strategy also filters stocks based on value, quality, debt, and relative strength. Interestingly enough, this strategy has delivered an astonishing annual return of 23%, almost like that, since 2009 in your site. But the Cambria funds have not achieved such a spectacular return. Can you elaborate a little bit on what this difference means and why an investor should understand the difference between picking a fund's guru or applying those strategies processed actively? Okay,
so that's a very good question. And there's a number of things to point out and highlight. The first is, even though shareholder yield is a quantitative strategy, there may be some slight differences in terms of the criteria, not with shareholder yield, but some of the other things. So that's the first thing. There around the edges, there may be some differences. That's number one. Number two is that the universe that we have to select from on the site might be different than what Meb uses. He may also have other portfolio construction rules that he uses to construct the ETF, where we're basically just following 10 and 20 stock portfolios and letting the model go wherever it may be. We do have some liquidity requirements in terms of filtering out ultra small caps, but I think Meb probably has even different liquidity requirements, given he's investing, I don't know what the fund size is today, but kind of a significant amount of money in the issues that he's holding. So those are, I think, a couple of the important things when you think about a model based on a book that can be largely replicated and someone else that's using the model. There's a number of differences that can go on that you can still get different performance results. Like even on Validea, we run not only a 10 and 20 stock model, but we run models that are rebalanced monthly, quarterly, annually, and tax efficiently. So there's a lot of different ways that we rebalance these portfolios to allow investors to follow different rebalancings. Obviously with the ETF, it's following one type of rebalancing frequency. There's two other things worth mentioning. It's kind of about the performance, what you said, but it's also, I think, just interesting that a lot of that excess return you're seeing has come in the past year. And why is that? It's because this model picked up GameStop in either April or May of last year. So you can imagine the type of return that that stock has contributed to the underlying strategy. Interestingly enough, Meb Faber's shareholder yield ETF also was one of the largest ETFs to hold GameStop. So this is an example where our model and the actual ETF that's being, selecting stocks using this model is aligned. But I think there's probably even, and so that's one, but there's probably even a bigger sort of lesson there. And just, you're not really asking me this, but I think it's very important, is when you see performance of an investment strategy, and I mean, listen, the model picked up GameStop. It was in a 10 stock model. Obviously the return of that security is going to massively influence the total return of the model, or I should say that it's not the total return, the model return, because our returns don't even include dividends. But the point is that when you look at an investment strategy and you see like returns of, maybe plus or minus 5 or 10% around the market, give or take, depending on the year, but then you see a year where where a model's up 120%, like, 5 times the market, you should be asking questions about that. As an investor, you should say, well, wait a minute. What happened here? What drove this? And not to assume that 23% annualized return, which basically, largely came all from that great performance because of GameStop, is something that can be replicated or whatever. So I just think that's probably the important thing I would like investors to take away is, you always want to dive under the hood, get under the hood a little bit if you can, and try to ask yourself what drove those returns.
Totally. Interesting. Mike?
Well, Ivan, I don't know if you want to ask a little bit about the work that you and Validea are doing with Zonavalue.
Yeah, for sure. Well, actually, there's a thing that I'd like to mention here. I mean, I'd like you to walk us through the benefits of using your screeners and your factor reports.
Okay. Yeah.
Because we have kind of had an agreement where we are having these tools for our subscribers and for our customers exclusively. And it's, I'm super glad about that. So we can offer your tools, the screeners and the factor reports, either for stocks or ETFs. So it would be nice to hear from you directly about this, the benefits of these tools for the investors that want to apply them.
Absolutely. And we're very excited to be launching this with you. I think it's nice when you can find partners where, you're aligned philosophically and you have similar visions with how to be a successful investor. So what we're basically doing, there's a couple things. I think through your site, we have basically integrated, and this, I don't think it's not live yet, but it's coming. There'll be a number of things that your users will be able to use for free. The stock factor report. So you type in a ticker symbol. Now we're getting off of the guru strategies a little bit. Okay. This is more factor based. So when I'm talking factors, I'm talking value, size, value, quality, negative quality, momentum, and volatility, like major investing factors, and then sub factors. So you can type in on your site, Apple, for example, and you can see how Apple ranks based on the high level factor of, let's say, value, but then you can come down one level and see also how the stock scores from sort of what sub criteria value factors. So we do that for specific stocks. We also do that on your site for specific US equity ETFs. And that's extremely valuable too. If you want to see what type of exposure does this ETF have, if you're looking at the ARK ETF or shareholder yield or QVAL or whatever, you get to see, okay, this firm says they're a value strategy, but if they're scoring very low on value, then maybe they're defining value differently and you're not getting the value exposure that you think you are. So that's how you would use that on the ETF factor report. And then also we have sort of, I guess, thinned down versions of our screening tools. So there's an Etf Screener and you can screen for things like factor exposures, active share, fee for active share, things like that, things that are important, I think, when looking at ETFs. And then there's also a guru stock screener, which that does tie back to the gurus, which is, if you want to see stocks that pass maybe the Benjamin Graham model or whatever gurus that will ultimately have up on there, there'll be a set of guru strategies that your users will be able to screen on. So it's kind of getting at, and maybe we'll talk about this at some point if we talk about Validea a little bit more. It's like, what can you use Validea for? You can use Validea to analyze different investment ideas, so that like an analysis engine, or you can use it for sourcing new investment ideas. And those are things like screening tools and model portfolios. And so some of that is coming into Zonavalue. It's pretty exciting. I think your users will be hopefully like the tool. And then we also have like I think we're going to do something where your clientele will actually get discounted access to the full Validea site. But I think that's, coming down the road.
It's actually, I have to say that I've been poking around because it's, it's already updated. So it's already in the site. I think today it was the day. So I'm super
great.
Yeah. And actually I was poking around it and it's really incredible. I mean, it's super funny also. So this idea of analyzing the ETFs, for instance, from this other perspective, it's really cool. It helps us understand other type of analysis, not the usual analysis that we can find anywhere. So I think our users and actually they're gonna use it for free. So it's thanks a lot, Justin. This is what I just wanted to tell you. Thanks a lot, because I think our users are gonna enjoy a lot. Totally. So I think we should leave it here, because now we have another interview that we are gonna shoot with Justin. And Justin, thanks a lot for this interview. It's been awesome. We will dub this interview into Spanish, so we will have it both in English and in Spanish. And I hope our audience is gonna enjoy a lot, as much as I've done. So thanks a lot, Justin.
Yep.
Thank you.
Thank you, Justin.